Hi there and welcome back to Dukascopy TV. Now, investors are hunkering down ahead of this week's FOMC meeting with the US Federal Reserve. But will investors get what they are looking for? Well, here to discuss is Michel Giradin. Michel, thank you very much for coming in today.
Hi, Monica.
Now, if we look at the upcoming meeting, there's been a sharp sell-off of long extended assets on the week of this, or as we look forward to this meeting. Do you think that investors are going to be satisfied? Will Bernanke be more dovish, do you think?
I think so. I think they will get what they want, i.e. a more accommodative tone in that, there's been signs that markets have been jittering, as you said, and also that the US economy has been slowing down. And so probably the Fed will be reassuring to investors this week.
Now, it seems to all hinge on the QE, whether they're going to start tapering it off, whether this asset purchasing is going to, end at some point. But if they do, if they say that, yes, it will come to an end, what will it really mean? What is it going to actually mean in terms of how the US economy will feel it, really?
Well, I think what's going to be reassuring to investors is that when the Fed starts talking about exiting the current quantitative easing program, the QE, it doesn't necessarily mean that they will stop at once. That's number one. And more importantly, it doesn't necessarily mean that they will have to raise interest rates anytime soon. And I think this is very reassuring. We've seen Fed officials talking to investors along both lines.
Now, if the Fed does decide to stick to the Evans rule with regards to interest rates, and also so that they hit that all-important percentage with regards to unemployment figures, do you think that this will really, do you think it's likely to happen? And if so, when?
Yes, I think the key here is whether the Fed will stick precisely to this so-called Evans rule, Evans being the director of the Federal Reserve in Chicago. And the rule states that interest rates will have to remain exceptionally low until we reach 6.5% on the unemployment rate figure. So the big question now is when is it likely that we will get there? And if we look at some charts, we see that much will depend on this figure, which is the total employment created each month, both on the private and government, which is the blue bars, and the private sector. So investors will be looking very much at what non-farm payrolls look like each first Friday of the month. When we look at the unemployment figures, we see that it's been easing from a peak of 10% post-crisis to the current 7.6%. So that's the good news. Well, we're still far from 6.5%, and what we see also from the next chart is that if we compare to previous recessions, we see, and it's the red line here, that unemployment rate has come down, but not as sharply as in the previous recoveries that followed the recession in '82. You see that after 1 year, 1.5 years after the recession, we were back to the level prior to the recession. And so also for the other recessions in 91 and in 01. So this recovery has much more a jobless tone than the previous one. So it's recovering the economy, but the job creation pace is still a bit moderate. So if we look at the next chart, we can answer the question of when will we get to this figure of 6.5, and that depends on the various assumptions we can make about non-farm payroll. So here you see on the vertical scale 4 assumptions. If we have 150,000 job creation a month, which is more or less the current pace, then it's not going to happen before 2018. If we get 200, then it will happen by 2015 Q3. And obviously if we get 300,000 job creation a month, we will be there in less than 1 year, but that's a very optimistic figure. So and also the other key variable on how fast we get to the 6.5%, is how the job participation rate will evolve, and that's on the last chart.
Okay.
So the job participation rate is currently at 63.4%. What does that represent? Basically, it represents the share of the labor force which is actively either employed or actively seeking for a job. And what we've seen since over the last years is that this job participation rate has actually been falling because of two conditions: demographic, the aging of population, and also some of the unemployed people falling off the unemployment numbers, either because they're discouraged or they reach the period where they don't get benefits anymore. So I've done some computations because the unemployment rate can fall also if that participation rate keeps on falling.
Yeah, of course.
And so I've done some estimates, I've run some estimates, and I assume that the job creation stays at the current pace of 180,000 a month, and the participation rate, if it stays at the current level of 63.4%, then we would reach the 6.5 unemployment figure in 2016 Q1. So that still leaves a lot of time for investors to be reassured that interest rates will remain low until that period. If the participation rate falls to the bottom line here, the 63%, then the period is shrunk, and we will have about 1 year for another, i.e. Q3 of next year. That's when the 6.5% unemployment figure would be reached. So as a conclusion, I can say that on my estimates, we can count on at least 1 year and up to 2.5 years of exceptionally low rates in the US.
It's fascinating. It's a stark difference from a lot of people who have said maybe as early as October, but obviously with your calculations, you can see that perhaps we have to wait this out just a little bit longer. But Michel, thank you so much for coming in and talking it through and sharing your perspectives with us. It's been fascinating.
Thank you.
Thank you. Well, that's all from Michel and myself. Please do click back to Dukascopy TV for plenty more exclusive interviews. Goodbye for now.